Firstly, your response to the IMF and the statement that they've made that monetary policy in Nigeria has conflicting objectives.
Well, thank you very much, Lerato. And I'd like to first of all start by saying that we appreciate the IMF's comments on our economy and the support it's given us so far. However, it's important for us to state that the days are gone when central bank governors simply accept everything that's said. Conflicting objectives in central banking are not unique to Nigeria. The United States Federal Reserve for decades had policies of pursuing price stability and full employment. Most central banks in developing economies do have policies that support financial system stability that is conducive to growth and development. And I think it's extremely dangerous to create the impression that having multiple objectives is necessarily mutually exclusive or conflictual. There is nothing that says that the pursuit of moderate inflation should blind us to the need for growth and development in a country like Nigeria. And this has been a source of debates with IMF. We think that the central bank in a developing economy is not an inflation targeter, and we have continued to say that we will pursue price stability, but we'll also continue to take seriously our role as a developmental bank and contribute to the growth of the real economy.
Let's focus on...
We don't see a necessary conflict.
Let's focus on this issue of managing high inflation. The sense is that the CBN has reduced its standing on deposit rates at banks, and that possibly going forward you should be taking bolder moves on MPR rates, not raising them by 25 basis points, but really making decisive stances so that you manage this inflation problem, which you yourself have been outspoken about.
Yes, but I think it's important to make a distinction between, we all agree on what is a right policy response, but that's also the question of timing. I don't think there's anyone that questions the fact that if you do have inflationary pressure, it is time for tightening. The question is, do you tighten money when you have a financial crisis in front of you? It is very bad economics when half of your banks are undercapitalized. Well, we don't have an asset management corporation bill for us to have tightened money. And this was our point with the IMF. We could not tighten money when we had a banking crisis. The United States still has quantitative easing because of the financial crisis. In the UK, inflation is at 4%. The Bank of England has not tightened. No central bank governor, after the Great Depression and what happened in Japan, would tighten money without finding a solution to the banks. Now, we had an AMCON bill that went through a legislative process during a difficult political period. It was not signed by the president towards the end of the year. Until we had AMCON and had the board of AMCON, it was too big a risk for us to start tightening. And the moment we had the bill and the board, we took the right steps. We signaled that we're going to tighten. The issue is not whether we should or should not have raised interest, but whether we should raise interest and tighten money at a time when the banking system was a big risk to the economy. Now that it's no longer a big risk, we've done the right thing. And this was our argument with the IMF.
What do you see by way of risks to inflation going forward? You mentioned the situation in the banks and the need to introduce the AMCON bill to try to rectify some of those liquidity issues. There's also the whole question of unbridled government spending, which has also added to inflationary pressures in Nigeria. Going forward, do you think we're going to see a situation where things get worse before they become better?
Well, we have always made it very clear, and if you follow our MPC statements from the middle of last year, we've always made it very clear that we think the time has come to start fiscal consolidation and retrenchment. We've always made it very clear that we should reduce overheads and recurrent expenditure, and this has been the position of the central bank. And our last MPC was very strong, and even prior to that, we've anchored our justification for raising rates on the rising specter of fiscal dominance. Having said that, you must remember that the CPI itself was rebased by the National Bureau of Statistics sometime last year. If you were on the old CPI, today would be on single-digit inflation. Inflation had declined consecutively from 14% at the beginning of 2009 to 10.3% in June last year. 10.3%, and it was going down. But in July, the new index came out, and inflation moved to 13%. So that jump, this 12.1% you've seen, is partly a reflection of a rebased CPI with different components and different weights. It is important for us as a central bank, when we understand the reason behind these numbers, not to have knee-jerk reactions. If we just jacked up rates by 200, 300 basis points and threw up yields by 500, 600 basis
Right.
points, it would be distortionary. We want stability.
Let's talk about other mechanisms at your disposal. I mean, some of the other concerns raised are structural issues, which we know about in the Nigerian economy. The fact that the country relies heavily on oil revenues to finance consumption, issues around productivity in the economy, things you know of. I think there have been questions raised as to the interventions taken by selling off reserves to buffer the naira instead of raising interest rates. What other options are available to you, do you think?
Well, the options available to a central bank tend to be quite limited. We do have control over interest rates, and obviously we can use the supply of the dollars at WDAS to mop up liquidity. We have chosen to go for exchange rate stability. It's not a fixed rate. I have made it very clear that we are not there to defend the naira at that level at all costs, but we do not see any fundamental reason for reducing the value of the naira. I have this debate with the IMF. The recommendations they make are themselves internally inconsistent. If we devalue the currency or if we depreciate the currency, it adds to inflation. If we have volatility in exchange rates, it affects inflationary expectations. The question is, tame this rate. And in a time of rising oil prices, stable revenues, we think we can. In fact, the attrition to reserves has ended. We have had gradual accretion in the last 3 months. So we made a distinction between a temporary depletion in reserves and what is permanent and sustainable. And our own trajectory, our own view was that we had run down reserves because we had special power projects. We had run down reserves because we had to invest money to replace the oil wells that have been bombed and the production facilities have been attacked during the Niger Delta crisis and get to production. And we had run down reserves to support the naira at the time when it had speculative attacks. Now that has gone. If you look at the demand profile, if you look at the exchange rate, we've been at 150, and we always say 150 plus or minus 3%, and stability in the exchange rate is central to our price stability objectives. And we totally disagree that the central bank should just devalue based on these short-term shocks, which are a reflection of a global crisis, especially since it was driven by liquidity, and we know that that liquidity was necessary for the banking system.
Let's talk about the naira just a little bit further. You've just said that you accept and understand that you cannot defend the naira at all costs, and we've seen proposals, for instance, at forward contracts in terms of forex sales. Is this a move towards just leaving the naira to the devices of the market?
No. We do think that we will continue to maintain a stable currency. And in fact, we do think that today we are in a much better position to defend the naira at this level than we were a few months ago. All prices are up, output is up. The demand for reconstruction and rehabilitation of structures is not where it was. The power reforms are going on. So we do not see any fundamental reason at this point in time for an oil-producing economy when oil price and output are going up for us to depreciate and devalue. What we did with forwards was basically to address the fears of those who have doubts about our willingness and commitment to defend the naira. We have done this transparently. We have said this is what we're doing. If we think there is a reason to change that and go to calling peg and move down 2-3%, we will announce it to the market. Everybody will understand that this is our own view of the long-term position. But the reserve position in Nigeria today covers more than 12 months imports of goods. It covers about 7 months imports of goods and services. We are not in any way in a desperate situation. And when people say the naira is overvalued, I ask them overvalued in relation to what? Nobody has given me an answer to that.
Final question to you, Governor. Some of the recommendations is that in pursuit of price stability, the CBN should eventually move towards inflation targeting. How open are you to that suggestion?
All talk of inflation targeting the Central Bank of Nigeria is prohibited so long as I'm governor. I don't think that a developing country like Nigeria can pursue that. There are a lot of structural problems. First of all, there are questions of serious limitations of monetary policy itself. A lot of the components in inflation in Nigeria is structural. We're an import-dependent economy. We import inflation through imports of food and energy. We do have a large component of our CPI being in agriculture, which is affected by the weather. And I think an excessive focus and an exaggerated belief in the power of the central bank to control inflation leads to policies that get to high rates of interest, sometimes create unemployment and create bad loans on the banks. We will continue to pursue implicitly a target of single-digit inflation, but we will do this along with our efforts to promote growth and development.